Welcome back to another episode of Fintech Frontiers, where we dive into the innovations, insights, and industry leaders shaping the future of financial technology. Today, we're absolutely thrilled to welcome a guest whose deep expertise and impressive journey through a world of financial services and technology makes him a true frontrunner in the fintech space. Itamar Bar Tura is the COO and co-founder of Takara, an exciting new venture that's already making waves. His career spans over 2 decades, including senior leadership roles at some of the most respected names in consulting: Accenture, Ernst & Young, KPMG, US, where he specialized in core banking, investment portfolios, and project portfolio management. From his academic roots in computer science and mathematics at Tel Aviv University to co-founding a company that's reimagining what's possible in financial services, and particularly in the mortgage space, Itamar brings a unique blend of technical rigor, strategic vision, and real-world execution. Itamar, you're extremely welcome to the pod. Thank you for joining me.
Thank you so much for having me, Steve.
It's a pleasure. It's a pleasure. So, as is the tradition on the FinTech Frontier podcast, we want to get straight to the big problem at the start of it. So, Itamar, would you be able to tell me what is the big problem that you've spotted in the market that you've become so engaged in that you've gone to solve it with this venture?
So again, thank you very much for the introduction, Stephen. Happy to be
My
here.
pleasure. Thank you.
So we founded Takara. I'll tell you a little bit about the company. So we founded Takara about a year ago.
Yes.
The 3 founders of the company kind of bring, I think, a great mix of experience. So I am the COO because of my background in technology and operations. We have another co-founder that deals with regulatory and compliance. He's an expert in compliance and regulatory from his work in other ventures. And we have the COO that was a trader, the CEO that was a trader and knows a lot about the market. So we've built a team that I think has the right DNA to bring this to market. What we're trying to solve is the lock-in effect in the US, what we call the golden handcuffs, which 65% of folks in the US have interest rate mortgages 30-year fixed with less than 4% interest. So
Right.
as the interest rates went up since the pandemic, the 2021 pandemic, from 4% to 7% today, or high sixes, people are reluctant to leave their homes. And what is perceived as a consumer problem is also a financial institution problem. So the consumers, they don't want to move to a new home, downsize or upgrade for whatever reason because they forfeit their benefit.
Yes.
On the financial institution side, they have these low yield assets stuck on their balance sheet, underperforming, where, just as an example, they're giving out deposits today at 4.5%, but they have, mortgages locked in at 3%, right? So they have kind of a mismatch on their balance sheet, unrealized losses. We've encountered this problem by looking at other markets. Some of the founders come from Israel, which is a very sophisticated lending market. And we've realized this problem, that people can't move and the stagnant market. And we've come up with a solution to address this problem. So this is kind of the market issue.
Right. And okay, I totally get that in the current interest cycle where it's high. Does that context change? Like, I know we've been through a long period of low interest rates, and maybe they're gone for good. I know there's a lot of uncertainty out in the market now, but is this business model good for all phases of the interest rate cycle?
Yeah, so we look at this as a mirror product to refinance. Right. So the interest rates goes up and down, very, very frequently. I remember myself, I bought a home in 2014 and, it was in New York, and it took about 6 months to kind of close to get a permit to inhabit the house. And during those 6 months, the interest rate went up by 75 basis points. So because of the delay in some of the CD approvals, I ended up paying much more interest on my mortgage. So the interest always fluctuates up and down. Now, our vision is when the interest rates go down, you need to refinance, right? When you have a mortgage at 7%, if the interest rates go down to 6%, you refinance your mortgage, you get the better terms. But if you have a 6% interest and the market goes up to 7 or 8%, you can take our process and basically benefit from what we offer. And we haven't spoken about that yet, but
yes, yeah.
you can benefit. So we are a mirror of the refinance. And to enter the market, you need a big difference between the
Yes.
rates and the current environment. But once you're in the market, we basically can offer a mirror product to
Right.
refinance product that's been existing and in the market for very long.
Okay. So, Itamar, just to recap then, so we have people that have locked in to long-term mortgages, 30 years. They're somewhere through on that journey. 4% or lower. Interest rates are currently higher. So they're reluctant to move from their house because they will get a they will lose the benefit of that lower rate. So tell me, what is the solution that you have crafted for them for this scenario?
So what we do is basically we offer the mortgage holder um, to pay off at a discount. So we say, look, if you want to return your mortgage, we can give you a discount on that mortgage. So instead of let's give an example. If you have a 500,000 mortgage at 3% for 30 years, we will be able to give you a payoff at 425. So you make $75,000 uh, discount on your mortgage if you want to pay it off. And it goes into your new mortgage. You reduce your principal, you increase your equity. So on the borrower side, basically, we allow you to kind of benefit from that low interest rate mortgage that you have compared to the current market conditions that you have to return the full rate and you basically completely forfeit that benefit. Now,
Right.
on the
So
lender side,
it cushions the move and it makes it more logical for the consumers then to be less troubled by, say, they want to move from one state to another or one house to another.
exactly.
It takes the handcuffs off, is that?
Exactly. That's the idea. Now,
Yes.
on the lender side, what happens is we generate a fee for the lenders. So we basically improve the yield on this existing low interest rate mortgage. We allow them to originate a mortgage at market rates, and basically we increase the volumes of their originations, right? So what we do is basically improve their situation, their position on the balance sheet. We upgrade their collateral. We basically create an improvement on their side as well. We basically found sort of an arbitrage that creates a win-win between the borrower and the lender. And you're asking about the golden handcuffs. It's interesting because we've looked at international markets, and there is a market that has a similar product, something very similar, which is Denmark. And what Denmark allows borrowers to do is to pay off their mortgage at a discount if the interest rates go down. So it's interestingly enough, in Denmark in 2023, when the interest rates went up, the refinance tripled. So we do see that the borrowers are taking advantage. This type of product is offered of this offering and allowing their borrowers to benefit from this market changes.
So you're actually gaining insights from different practices in, say, Israel or Denmark and how consumers are reacting to that. And then you're saying, hey, this is something will be relevant to US consumers and it's relevant to the current phase of the interest rate cycle also. And there's something in it for the lenders. Okay, great. And can you tell me what's your process for accessing those borrowers? How are you getting to market?
So we define ourselves as B2B2C. So this whole transaction is basically consent based. And our approach is to go to lenders and convince them that this infrastructure and this product is a beneficial offering for them to add to their array of products and offer this to their borrowers. And then the operating model is basically that the bank deals with the borrower, with their borrower, not us.
Yes,
It helps us
yes,
secure the funding. We're very concerned about safe and soundness to make sure that, a borrower deals with a trusted financial institution. They know the bank, they're offered this offering by the bank, and the bank kind of protects them. We're very cautious with all kinds of solutions in the market that allow fintech companies to directly engage with borrowers on such important financial decisions. So the whole
yes,
infrastructure was created to protect the financial institution and the borrower from any leakage of the funds, right? So basically, the financial institution is the one that interacts with the borrowers, collects the funds, and then we support the financial institution with the transaction. But the
yes.
borrower is always protected and always dealing with a trusted financial institution. So
Great.
that's how the infrastructure was created.
Super. And is your use case then that the if is refinancing the right term of the mortgage that actually takes place, that the borrower is typically remaining with their existing financial institution, or is there a change?
Right. So the borrower we basically provide the offer to the borrower, and the borrower
Yes.
is free to take a new mortgage anywhere else, right? But the idea is, from an institution perspective, is if you have a lender that offers you great products, right, it's more likely that you would take a new mortgage, and you would continue that trusted relationship with that lender. Part of our go-to-market approach was to go to the credit union market, and we spoke about this.
Yes.
The credit unions being something that's very common also in other places in Europe. But it's a very interesting market in the United States. It's a very interesting dynamic between, members. It's nonprofit. It's
Yeah.
very, very member friendly. And it's more likely if you offer this to members of credit unions that the new loan will be taken by that credit union. So our
Okay.
go-to-market approach
Great.
initially was to deal with the credit unions and offer this to their members.
Great. And this comes back to your B2B to C model. Are, is Takara then in talks, in discussions with credit unions? I know that financial institutions often engage with fintechs because they feel that they can achieve a quantum leap in terms of the service offering in a way that they might not be capable of doing themselves by engaging with very innovative fintechs such as yourselves. Is that you're talking to those credit unions and saying, hey, this is something that could make your business better and make make for better deals for your customers as well?
Right. And I think the credit unions call their customers members, right? So it is nonprofit. It's very, very member friendly. It's basically
Yes.
giving your members something that nobody in the market is offering, right? Which is sort of a fair
Fantastic.
deal. They've secured their low interest rate mortgage. They don't want to give it up. Let's incentivize them, give them the incentive that they've earned, and allow them to kind of, improve the quality of their life. We're seeing in the market people that, have another child, upgrade their home, but are reluctant to do it because the monthly payment's going to go up so significantly that they can't afford it, right? We want to help them afford that. So we are coming to these credit unions and basically providing them the infrastructure, the knowledge, and the technology support to implement this product and offer it to their members. So they're going to go to their members and
Excellent.
say, we have a new offering to help you improve the quality of your life, allow you to move. That's the idea. That's in
Brilliant.
our DNA as the company's
Excellent.
DNA.
And tell me, when was the company established and where are you on your go-to-market journey currently?
So we were established about a year ago, and we're talking to these credit unions. We have one credit union that's in the process of implementing the product.
Brilliant.
We have a few in the pipeline. And the way that we've structured so we've just secured some additional funding to help us um, go to market and help us attract these financial institutions. And the way that we've constructed, right now we're focused on sales, right? So we're trying to get more credit unions inside the pipeline. Our target is to try to close by the end of this year, at least 3 or 4 new customers, right? And as we go through that year, the yearly budget plan is to transition from sales modes into operation and technology, right? So as we look at
Yes.
the way that we've constructed the budget for the company, the next 3 or 4 months is heavily focused on sales and market penetration, and the months after that are starting to shift from sales to more to product execution, to
Yes.
technology, and to operations, right? So that's
Fantastic.
kind of the way that we've created the funding. We've distributed the funding in the upcoming year.
Great. Super. And an exciting journey. Tell me this, oftentimes fintechs that are involved in the credit space, they actually need to go to the the private credit providers to get funds to lend out. Is that's not the case for your business model, is it? Or
No, because the
no?
way we operate, right? We allow the borrowers to get the benefit. So once the borrower pays out, we basically take that payment and we use it to secure the settlement of that loan, right? Against the financial
Right.
institution. So we basically take the loan from the customer, but we're always kind of breaking even because the customer provides the funds. So we do need some credit, right, in the interim, but it's not like we need to lend people money or anything like that, right? So,
Yes. So
so
it's just some bridging
there is a bridge, right? There is
finance. Yes.
exactly
Okay.
between the time of the closing of the transaction, but except for that, we don't much credit.
Lovely. And tell me a little bit about your business model. So how this would generate returns for your shareholders.
So the way we offer what we basically offer So the customer walks out free and clear, right? The customer pays with a benefit. The lien on the property is released, and the customer basically is walking free and clear, debt free from this transaction.
Yes.
What we do is we basically
But into a new one typically, so they're clear from their previous one. They're going into a new one.
right.
That's
I
it,
mean,
right?
it's their decision. They can decide they just want to pay off the mortgage, right? They have
Okay.
cash and we'll give them a discount.
Yes.
They just want to pay it off, right? A lot of people want to
Right.
be debt free. There's a lot of use cases and what you use that money for. But typically, you're right. The main use case is for people that want to upgrade their property. They want to move. They can't move
Yeah.
today, and we provide them the benefit. So that's from a borrower side. The borrower does have some fees associated with the setting up of this transaction. So there are fees generated for the financial institution and for us. And the other thing is that we continue maintaining this loan. So we've got some servicing fees that we get. So we have a one-time fee for the origination of the transaction, and we have a servicing fee
Yes.
that's recurring revenue for the company. So our
Excellent.
business model is basically to both sort of like a one-time operation and then sort of a subscription fee, a servicing fee that we can kind of create a sustainable business for the company and recurring ARR.
Well, that's it's good to have a mixture of income types and particularly for fintechs having ARR is very valuable it's very important for the company's valuation. Okay, very good. So where where to in the next 12 months or the next 24 months, do you think?
So, I believe that we can penetrate the market. We do have some challenges that I think every fintech owner is encountering, right? So we're trying to
Yes.
tackle these challenges from a go-to-market perspective. And I can tell you what those are. The first thing I think is relationships and reputation, right? And I box these two things together. You mentioned my consulting background. Say in consulting that we try to sell a project, we create a relationship map of the customer.
Yes.
Who was a
Yes.
former employee, who had a successful project with us, who was a former employee of a competitor that has a good relationship with a competitor, who had a failed project with us, right? And the experts in sales used to say, if the relationship map says you're not going to sell it, you're not going to sell it, even if you have a superior product. And that also
Yes.
makes sense because people want to go to battle with people they know and they trust, right?
100%.
So when you're coming in with limited relationships, specifically in the credit union space and the smaller banks,
Yes.
me in the consulting, I've met many of the big banks and dealt with them, but the
Yes.
smaller banks, the relationship is more complex. So, that is something that we need
Yep.
to tackle and we're working on tackling. So our
Yes.
first approach to answer your question for the next year is we tried to fix that problem, right? The reputation and
Yep.
relationship problem.
Yep.
I think the other challenges that we're having is regulatory and compliance.
Of
Very, very
course.
heavily regulated space. I don't know if you know the interesting thing that the 30-year fixed mortgage was created in the 1930s, right? It was
Right.
it was after
Yes.
the Great Depression, and it was
Was that
created to
part of the New
stabilize.
Deal, or
Was
was
that?
that part of the New Deal?
Yes, I
Was it,
think
or
so.
something like that?
I
Yeah.
think I think so. It was to standardize the housing market after the Great Depression,
Yes.
and
Wow. Yeah.
15-year, by the way, fix came much, much later in the 80s for people that have more equity and more capital. So it's a richer
Okay.
population that take the 15-year versus the 30-year.
Really?
Yeah.
Right.
So it's something that hasn't changed for almost 100 years, the 30-year
Yeah.
fixed mortgage. And, to introduce innovation to something
Yes.
that hasn't changed in 100 years is very complex, right? And specifically the regulatory and compliance space is very complex. So I think those are the two main challenges. So what
Yeah.
we're doing to mitigate those is we're bringing up advisors, people that have good relationships with the financial institution. With these advisors, we
Yes.
have more time to spend. So we're giving them a better overview of the product. And when they go
Right.
to their relationships, they can do the one-on-ones. And when we come into the meeting, it's easier to explain because it does take some time to grasp this
Yes.
product from a financial perspective. And then the same thing we're doing with the regulators, right? We're providing some go-to-market material. We're talking to the regulators on the side. We're going
Yeah.
with the trusted financial institutions together to the regulators. So our
Yes.
vision for the next year, as I mentioned, the first 4 months is going to be to focus on relationships, sales, How do we penetrate the market, talk about the innovation, and then our target in the next months is to transition to operations, to acquire more financial institutions through transactions and not through sales. So that is our kind of approach, our go-to market
Yeah.
in this year.
And um, from your business models, is it correct to say that you wouldn't require a any license from the regulator that that the you'd be operating under the license of the financial institutions that you're working with?
That's right. So,
Yeah.
so no license required, and the dealing with the regulator. The interesting thing is the regulators, when they hear something new, they don't typically say yes. What we want them is not to say no, right? Is to say, look, let's try this out. And the way we've constructed this with the regulators to actually keep this safe and sound is we're a transaction-based company. We don't do a portfolio deal, which is like we don't move $1 billion in one day, right? So we can start with 5 or 6 loans, right? Get the blessings of the regulator. The regulators can look at, after we do the first initial transactions, the regulators can look at the results and kind of approve. If you have a bank with billions of total assets, moving one or two
Yes.
mortgages is not going to make a difference. And the reason
Yeah.
I mentioned that is this is something very important when dealing with regulators and dealing with something that's very heavy from a compliance perspective. Is start small, right, and scale
Yeah.
up, and not come with a
Yes.
solution that's not talk about scale in day one and we're going to move billions, because that creates a lot of uncertainty and fear with the
Yeah.
regulator, rightfully so. So what we're trying to do is create something that's digestible by people, right? And we say, let's do something. You'll see the results. We'll do this hand in hand with you. And when you see that this is safe and sound, we can move forward to scale this up gradually. And you will not
Yes.
find yourself in a situation where you don't understand the financial implications of something
Yeah.
before it happens.
Yeah. And I guess also by just getting those few, say, pilot mortgages or transactions through, that it creates a story or a narrative and something that the financial institution can see. We started here, we did this, this is the outcome. And likewise that the member or the customer, if it was a bank, can see, well, you know, and also a narrative, I guess, for the regulators, so that rather than explaining the concept, you're telling the story of what's happened here. Okay, excellent. And how then, say, as you're talking about the journey going forward, moving from that sales mode to the operational mode, I know that you've got three very, very experienced and capable founders. Is that going to be a complex journey, or something that on the one hand you're saying, look, this is we're selling it now, and then as it's getting accepted, being able to deliver then is the next phase. Like when you're going in, oftentimes fintechs, we hear the B2B, particularly in the larger financial institutions now. I know you're talking about the credit unions and it's a slightly different context, but that journey through, procurement, to IT security, IT infrastructure as well, into the financial institution, and making sure all those stakeholders, is that a difficult part of the journey then, having this product working within the credit union's infrastructure?
Yeah, I think that's a great question. And the way we try to design the infrastructure for this is to do something that we can scale up through trusted financial institutions, right? So we have part of this infrastructure is a trust that is a trusted financial institution in the United States. And we facilitate, pieces of technology around the journey, right? And we will need some additional operational. And that's why I said the budget's going to move from sales to operations. We need to hire some additional folks that will help us maintain this. But the idea is to gradually grow with scale, right? So as we scale up quickly, and we can use, the infrastructure of the financial institution, the infrastructure of the trust that we've, contracted with to handle the first transactions, and then gradually grow as operations become more frequent, as we open up more financial institutions. But the idea of this fintech is to create technology that enables the operations around the existing infrastructure. Right? So we can use
Right.
existing systems of the bank to do origination. We don't need to write the origination engine on our side. So we can
Yeah.
tap into the existing infrastructure And that helps us, as you mentioned, the B2B2C helps us deal first with the financial organization and only then with the customer.
Yeah. So, and okay, very good. And I guess again, the consulting experience in financial technology must come in very useful then when you're executing on change within a financial institution. And is it a white labeling exercise then that the trusted financial institution is crafting a message and getting it out to its members and saying, hey, you're thinking of moving home. This is something you should consider. And how does that messaging get created, evolved, or distributed?
Yeah, that's exactly right. It is a white label. It is a product that we offer the bank, but you don't have to start in day one, right? At day one, you can just say, send the customer an email, here's your custom offer. We provide a lot of white label. We already have a white label website that we can use to kind of explain to the borrower, Q&A, frequently asked questions, a calculator of what your benefit could be, a calculator of what your new mortgage could be if you upgrade your home to a different home, more expensive, same price. So we have all of that already built to support clients in dealing with their customers. Already a white label site that you could put your logo on, that we can assist you with the routes of this financial product. So we already kind of have that pre-built for customers to show this is how we can help you kind of talk to the customers. We have pre-created scripts. So we already have kind of all the routes of the products already built to help the financial institution kind of explain this to their customers or members.
Well, I mean, in the current market, it must be a very welcome new offering because, as you say, there's balance sheet issues for the financial institution, and there's pent up demand amongst those 30-year fixed mortgage holders. They may have a new child, they might need a new room, might want to move their home closer to the public transport, whatever it might be. By, as you mentioned, by taking these golden handcuffs off, it allows people maybe to evolve their situation for the changing needs in their lives without having to wait for some, change in the interest rate cycle to be able to make the kind of moves that maybe that their personal situations demand. So I think it sounds like it's fintech for good from that point of view.
Yeah, our belief is that once this enters the market, people are going to be very, very excited. I think it's a great offering. I think, we're seeing from the Denmark market that if this is offered, people actually use it. People want this product, and it's the same thing in the US. If you do that in Denmark, you have to take sometimes a new loan at market rates. But people want to get the benefit. People want to reduce their debt. If you believe the interest rates are going to go back down, you take the benefit right now, and then you can refinance later. So it is very, very member friendly. It is surprisingly also very, very lender friendly, right? So also the lenders, can get a huge benefit from this product. So we really believe it's a win-win. We believe that once it enters the market, people are going to see that and get very excited. It's going to be something that we are hoping that influences people's lives in a positive way, like you mentioned. So we're very excited to put this into the market and help folks.
Yeah, well, look, I think it's going to be a great new choice you're going to be putting on the table for them. And I very much look forward to watching how Takara's journey evolves over the coming months, quarters, and years. So well done and more power to you. Thank you very much, Itamar, for joining us on the podcast today and sharing your story.
Appreciate it.